A loan estimate is exactly what it sounds like. It's an estimate. Once you have an accepted contract and you send it, your lender locks your rate and sends you disclosures. One of those disclosures is called the loan estimate, or LE. This document causes a lot of confusion and anxiety for buyers. So I want to walk you through the most important parts, and more importantly, what actually matters and what doesn't. I wanted to mention a quick note before we dive in. The numbers you're about to see are not meant to match your situation. This is a generic CFPB sample and is usually higher than what most first-time homebuyers actually see. Today is about understanding the layout, not the math. The first thing that I always try and go over with my customers is the property address. We want to make sure the property address is right. We want to make sure the sales price is right. Over here, we got the loan term, 30 years. Product, it's a fixed rate. That means the interest rate's not going to change. And the loan type is conventional. Again, sales price $180,000, loan amount $162,000. That right there tells you the down payment. Just subtract $162,000 from $180,000. We got an interest rate right here, 3.875. And this is your monthly principal and interest. I would say some of the newer loan estimates may not have it here. They'll have it just down here. But $761.78 is the principal and interest. Now, that's not the mortgage payment. Mortgage payment includes mortgage insurance and estimated escrow, which is your property taxes and homeowner's insurance. If you put more than 20% down, you will not have mortgage insurance. Escrow is property taxes, homeowner's insurance. Sometimes this is more common in condo associations. You'll see homeowners associations that are tied into the mortgage. Typically, though, those HOA fees are separate. Estimated closing cost is right here, $8,054. Estimated cash to close, this includes down payment and closing cost, is $16,054. You're going, well, hold it. They were putting $18,000 down. So what's going on? I'll show you. So we're going to scroll down. Origination charges. These are charges essentially that the lender is charging. This borrower is paying 1/4 of a point, $405 to buy the rate down. They have an application fee and an underwriting fee. These are where you'll see lender charges or origination charges. Down here, services you cannot shop for. This is the appraisal. I see the appraisal on here a lot. There may be other ticky-tack fees on here, but the big one usually is the appraisal. And then down here, services you can shop for, pest inspection fee, survey fee, and then title insurance. And this is a little pricey for title insurance. In Ohio, you're going to be closer to $2,200 to $2,500 total for all title. In Indiana, you're going to be closer to, I'd say, $1,200 to $1,500. Again, you get the shop for these. Taxes and other government fees. This is really county specific. Montgomery County, Ohio, it's a little bit higher than, say, Dark or Preble. I think you'll notice that more rural counties have lower fees than some of the bigger city counties or counties that have higher populations. Here are the prepaids. Prepaids are your first year's homeowner's insurance. On this one, they're only collecting 6 months. Most lenders collect 12. I know we collect 12 months at closing. So 12 months of homeowner's insurance is collected at closing. Prepaid interest, depending on when your first mortgage payment is, you may have some days of interest in there. And then property taxes. So on this one, however their county is handling the property taxes, nothing has to be front loaded in this. I've seen some counties where 6 months are collected, and I've seen some where none. And then here's the escrow. So prepaids pay for stuff that's coming due this year. Escrow is building up an account for things due next year. So homeowners insurance, collect 2 months. Property taxes, they're collecting 2 months. So it's going to put about $400, $413 in that escrow account. So next year, come renewal, there'll be more than enough money in there and there won't be a shortage. Title owner's policy, this is optional. I would always recommend getting an owner's title policy. But there's that right there. And then there's no lender credits on this. Now, as I stated before, we're going to hold it. They put $18,000 down, but how come they only need $16,000 at close? That's because they put a $10,000 deposit. So their actual out-of-pocket on this is $26,000. Now down here, seller credits. This is one thing. There's no seller credits on this. In our market, seller credits are very common, especially for first-time home buyers. And this is where it's really important to work with your lender and your realtor in tandem. So when you present offers and you negotiate, you can make sure you're negotiating in a way that keeps your cash to close where you want it to be, as well as your mortgage payment.